Cash flow is what kills more growing agencies than any other single factor. Not bad sales, not bad markets. Cash flow. The agency was profitable on paper, ran out of cash in a slow month, and couldn't make payroll or fund the next hire. This training is about how to read your cash flow honestly and when to reinvest versus when to hold. There's a critical difference between profit and cash. Profit is what shows up on the year-end tax return. Cash is what's actually in the bank on the 15th of the month when payroll runs. Most agency owners track profit. Very few track cash flow weekly or monthly. The ones who run into trouble almost always have a profitable agency on paper and an empty operating account in practice. Why the gap exists. Insurance commissions arrive on a delay. New business commissions can be paid 60 to 90 days after the application is submitted. Renewals come in monthly, but vary wildly month to month. Profit sharing arrives in an annual lump. Bonuses hit quarterly. Meanwhile, expenses run every single day. Payroll twice a month. Lead spend weekly. Rent monthly. Software subscriptions monthly. Carrier appointments and licensing annually. The mismatch between when revenue arrives and when expenses go out is the entire problem. Why this matters at the owner level? Because every decision you make about hiring, lead spend, technology, marketing, or office space comes back to one question. Does the cash flow support it? Most agencies that fail to scale don't fail because the strategy was wrong. They fail because they tried to fund growth with cash they didn't actually have, and the next slow month forced them to reverse decisions that should have been permanent. The good news is, cash flow management isn't complicated once you build the habits. The agencies that get this right have a system. The agencies that don't make decisions based on what's in the account today, which is the worst possible way to run a business that has lumpy revenue. Build the cash flow system in 3 layers: the forecast, the reserve, and the reinvestment rules. Layer 1, the forecast. Build a rolling 13-week cash flow forecast. 13 weeks is the right horizon because it's long enough to see seasonal swings and short enough to be accurate. List every expected inflow week by week. New business commissions, renewals, overrides, expected bonuses. Then list every expected outflow: payroll, rent, software, lead spend, carrier fees, taxes, owner draw. Update it weekly. Compare actual to forecast every Friday morning. Within 60 days, you'll have a forecast that's accurate within 5%, and you'll be making decisions on real information instead of guesses. Layer 2, the reserve. Hold 3 to 6 months of operating expenses in a separate account that does not get touched for day-to-day decisions. This is the buffer that lets you absorb a slow quarter, a delayed bonus check, or a carrier commission delay without panic. 3 months is the floor. 6 months is where the agency starts to feel stable. Anything less than 3 months, and the owner is making decisions out of fear instead of strategy. Layer 3, the reinvestment rules. Decide in advance what percentage of incoming cash gets reinvested into growth. What percentage stays as reserve? What percentage is owner compensation? And what percentage covers taxes? Write the rules down. Stick to them. Most agency owners reinvest reactively, which means a great month leads to overspending and a slow month leads to retrenchment. Predetermined rules eliminate the emotion. A simple reinvestment framework. After taxes, owner draw, and reserve contribution are covered, allocate remaining cash by tier. Tier 1, producer hires. The highest return reinvestment in any agency is usually a new producer. A producer who can write $30,000 to $50,000 in commissions per month against a $50,000 to $70,000 annual base salary is roughly 6 to 1 return on capital after the ramp period. The math beats almost every other use of agency cash. Tier 2, lead generation. Higher lead spend is the second highest return reinvestment when the agency has the producer capacity to convert it. Spending more on leads when producers don't have time to work them is wasted cash. Spend more on leads only when the calendar can absorb the volume. Tier 3, operational hires. Admin staff, customer service, and processing support free up producer time to sell. The math here is indirect. The hire doesn't generate revenue directly, but it removes hours of low-value work from producers, which gets converted into appointments. Track this carefully. The right operational hire pays for itself within 90 days. The wrong one drags margin for a year. Tier 4, technology and systems, CRM, automation, AI tools, quoting platforms. These investments compound over time but show no immediate return. Budget a fixed percentage of revenue for technology, usually 3 to 5%, and stick to it. Don't chase shiny tools and don't underinvest. Both extremes hurt. Tier 5, brand and marketing infrastructure, website, content, podcast, paid awareness campaigns. These are slower returns but build the moat. Invest only after the higher return tiers are funded. The percentage is worth knowing. Industry data on agency expense ratios looks roughly like this. Payroll, including owner compensation, runs 50 to 75% of revenue at most agencies, with 65% being a common target. Office and operating expenses, including rent, software, and administrative costs, run 10 to 20%. Marketing and lead generation runs 5 to 20%, depending on growth phase. That leaves a profit margin of roughly 15 to 30% on a healthy agency, which is where the owner draw, taxes, and reinvestment cash actually comes from. Compare your agency to those benchmarks honestly. If payroll is over 75%, the agency is overstaffed for the revenue. If marketing is below 5%, growth is starving. If profit margin is below 10%, something structural is wrong and reinvestment isn't the answer. The cash flow problem might actually be a structural problem. Let's walk through what this looks like in practice. Diane runs a 4-producer agency that grew quickly in years 2 and 3, then ran out of cash in year 4 despite booking record revenue. She'd hired 2 new producers in the same quarter, increased lead spend by 60%, signed a longer office lease, and bought new software. Every decision was reasonable in isolation. Together, they pulled cash forward faster than commissions could refill it. She rebuilt the system. Started with the 13-week forecast, updated every Friday. She paused the lead spend increase for 2 months until producer capacity caught up. She negotiated payment plans on 2 large annual expenses to smooth the cash hit. She set a target reserve of 4 months and committed to building it back over 12 months. 6 months later, the agency was producing similar revenue with a different cash profile. The reserve was rebuilt, the forecast was accurate within 3%. New hires were planned 90 days out against projected cash position, not last month's commission report. Same strategic decisions, grounded in numbers instead of optimism. The pattern matters. Cash flow problems aren't usually about revenue, they're about timing and discipline. A few common mistakes to avoid. The first is mistaking a great month for a permanent trend. One big check or one bonus payment doesn't justify locking in a long-term expense. Wait for the trend to confirm. The second is hiring without a forecast. Every new hire commits the agency to a recurring expense for at least a year. The decision should be made against 13 weeks of forward visibility, not last month's bank balance. The third is mixing personal and business cash. The owner draw should be defined and predictable. Pulling extra in good months and taking less in slow months hides the real cash position and breaks the discipline of the system. The fourth is reinvesting all of it. Profitable agencies set aside a portion every month that doesn't get reinvested. Reserve isn't optional. It's what protects every other decision. Here's your action step. This week, build the 13-week forecast. Open a spreadsheet. List every expected inflow and outflow by week for the next 90 days. Compare next Friday to actual and refine. Within 4 weeks, you'll have a working forecast. Then set the target reserve in dollars and build a plan to reach it. 3 months minimum. Cash flow discipline is what separates the agency that grows steadily from the agency that grows in lurches and crashes. Build the system, run it weekly, and the agency